Imagine spending your entire life working hard, saving money, and building your retirement fund. Then one day, just after you retire, you begin hearing experts say that one of the most trusted retirement strategies in America might no longer work. That's exactly what's happening in 2026. For decades, millions of Americans have relied on something called the 4% retirement rule. Financial advisors, retirement planners, and investors have recommended it as one of the simplest ways to estimate how much money you can safely spend after retirement without running out of savings. But today, rising inflation, higher interest rates, longer life expectancy, and unpredictable stock markets are making many people wonder whether that rule is still reliable. So, what exactly is the 4% rule? The idea is surprisingly simple. Suppose you've saved $1 million for retirement. According to the 4% rule, you could withdraw 4% of your savings during your first year of retirement, which would be $40,000. In the following years, you would adjust that amount for inflation while keeping the rest of your money invested. The goal is simple: provide a steady income while giving your investments enough time to continue growing. For many years, this strategy worked surprisingly well because it was based on decades of historical market data in the United States. But the world has changed. Inflation has become more unpredictable, interest rates have risen, markets have become more volatile, and people are living longer than ever before. That means retirees may need their savings to last 30, 35, or even 40 years instead of the shorter retirement periods assumed in earlier studies. So, is the famous 4% rule still safe? Or could following it today actually increase the risk of running out of money during retirement? If the 4% rule has guided millions of retirees for decades, an important question naturally follows. Where did this rule actually come from? Many people assume it was created by the government or by a large financial institution, but that's not true. The 4% rule traces its roots back to financial research conducted in the United States during the 1990s. One of the most influential studies examined how different retirement withdrawal rates would have performed throughout American market history. Researchers looked at decades of real data, including periods of economic growth, recessions, high inflation, market crashes, and recoveries. Instead of relying on theory, they tested what would have happened if retirees had withdrawn different percentages from their portfolios each year. The goal was simple. How much could someone withdraw every year without running out of money over a 30-year retirement? After analyzing thousands of historical scenarios, one result stood out. A retiree with a diversified portfolio of stocks and bonds who withdrew about 4% during the first year of retirement, then adjusted that amount each year for inflation, had a high probability of making their savings last for 3 decades. That finding became known as the 4% retirement rule. Over time, financial advisors embraced it because it was easy to understand. Instead of guessing how much to spend each year, retirees had a practical starting point for planning their income. But it's important to remember something many people overlook. The 4% rule was never meant to be a guarantee. It was based on historical data, assumptions about market performance, inflation, and a retirement period of roughly 30 years. Every retiree has a different lifestyle, different expenses, different investment portfolios, and different financial goals. So while the 4% rule became one of the most respected retirement guidelines ever created, it was always intended to be a guide, not a promise. And today, with higher inflation, changing markets, and people living longer than ever before, many experts are asking an even bigger question. Can a rule created from the past still protect retirees in the future? If the 4% rule worked so well for decades, why are so many financial experts questioning it today? The answer isn't that the rule suddenly became wrong. The problem is that the world has changed. When the original research was conducted, inflation was generally more predictable, Interest rates follow different cycles, and many retirees expected their savings to last around 30 years. Today, the financial landscape looks very different. Inflation can remain high for extended periods, reducing the purchasing power of your retirement income. Even if your investment account stays the same size, every dollar may buy less than it did a few years earlier. At the same time, people are living longer than ever before. Many retirees may now spend 30, 35, or even 40 years in retirement. That means their savings must support a much longer lifestyle than earlier retirement studies assumed. Market volatility has also increased. Large swings in stock prices can have a significant impact during the first few years of retirement. If your portfolio experiences major losses while you're also withdrawing money for living expenses, recovering becomes much more difficult. Financial planners call this sequence of returns risk. It means the order in which investment returns occur can matter just as much as the average return itself. Two retirees with identical portfolios could end up with very different outcomes simply because one experienced a market crash early in retirement while the other faced it much later. This is one of the biggest limitations of relying on a fixed withdrawal rule. That's why many financial advisors no longer recommend following the 4% rule blindly. Instead, they encourage retirees to review their spending, adjust withdrawals when necessary, and regularly evaluate their investment strategy based on changing market conditions. The goal hasn't changed. The goal is still to create reliable retirement income without running out of money. But achieving that goal today may require more flexibility than ever before. If many financial advisors are becoming more cautious about relying only on the traditional 4% rule, what are they recommending instead? The answer isn't abandoning retirement planning. It's making retirement planning more flexible. Instead of withdrawing the exact same inflation-adjusted amount every year, many financial planners now recommend adjusting your withdrawals based on your personal financial situation and current market conditions. For example, if the stock market has a strong year and your investments grow significantly, you may be able to withdraw a little more without putting your long-term retirement at risk. But during years when the market falls sharply, reducing your withdrawals even temporarily can help preserve your portfolio and give it more time to recover. Another important strategy is diversification. Rather than depending entirely on stocks, many retirees spread their money across different investments such as bonds, cash reserves, dividend-paying investments, and broad stock market index funds. Diversification can't eliminate risk, but it can reduce the impact of major market declines. Financial advisors also recommend maintaining an emergency cash reserve outside your investment portfolio. Having cash available for unexpected expenses can help you avoid selling investments during a market downturn when prices may be temporarily low. Many retirees are also choosing to remain flexible about retirement itself. Some work part-time, freelance, consult, or earn income from hobbies during the early years of retirement. Even a small amount of additional income can reduce pressure on retirement savings and allow investments more time to grow. Perhaps the biggest lesson is this: successful retirement planning isn't about finding one perfect rule. It's about regularly reviewing your financial situation, adjusting your plan when necessary, and staying disciplined during both good markets and bad. The best retirement strategy is one that can adapt as your life and the economy changes. After everything we've discussed, one question remains. If the traditional 4% rule may not be enough by itself, what should retirees actually do in 2026? The answer is surprisingly simple. Don't rely on a single rule. Build a complete retirement system. The first step is knowing your real expenses. Many people underestimate how much money they'll actually need during retirement. Housing, healthcare, food, travel, insurance, and unexpected expenses can all change over time. A realistic retirement budget is one of the most powerful financial tools you can create. The second step is building multiple layers of protection. Diversified investments, emergency savings, and flexible withdrawal strategies can work together to protect your retirement from inflation, recessions, and market crashes. Third, review your retirement plan regularly. Retirement planning is not something you do once and forget forever. Your spending, health, investment returns, and financial goals may change over the years. Reviewing your plan annually allows you to make small adjustments before small problems become large ones. Fourth, avoid unnecessary debt before retirement whenever possible. High-interest debt can place enormous pressure on retirement income. Entering retirement with fewer financial obligations can provide significantly more flexibility and peace of mind. Fifth, keep investing even after retirement. Many people believe investing stops when retirement begins, but retirement may last 30 or even 40 years. Your money often still needs to grow to keep up with inflation and future expenses. And finally, remain flexible. Flexibility may be the single most important retirement strategy in today's economy. Markets change. Inflation changes. Life changes. Your retirement plan should be able to change too. Because successful retirement isn't about predicting the future perfectly. It's about preparing for uncertainty. The goal was never to blindly follow the 4% rule. The goal has always been financial freedom, confidence, and a retirement that lasts as long as you do. And the people who prepare early often give themselves the greatest advantage of all. Time to invest, time to adapt, and time to enjoy the retirement they've worked so hard to build.